I know back then you saw rates start to move around, interest rates start to move around. And fast forward to today, you know, the pandemic, it's been a year. We've seen the economy, we've had an election, unemployment. I mean, crazy GameStop things happening in the market. You name it, it hasn't been short of events. Interest rates, that's your expertise. You're an expert in the rates market. Until
Mhm.
recently, rates were at generational lows. They're still very, very low, as we know, but they started to tick up a little bit recently. In your opinion, Nancy, what's changed?
Well, a couple things have changed. I think, we've had a blue wave come through. We're having a huge, another round of fiscal spending. We have the average inflation targeting now, where the Fed, is not going to have a symmetric mandate on inflation. And then at the same time, we have them not even thinking about raising rates. But I think the one kind of weird thing since the middle of February is that the rates market has actually started to price in hikes now. When you look out in the forward markets, you can see out in 2022, a little over a full hike is priced in 22. And then if you go out to 2023, you actually have almost four hikes that are being priced in. So it's kind of a really interesting time because the forward guidance has been working, but now the rates market is not listening to that forward guidance and pricing in these hikes.
And that's interesting because we've seen in the last couple of months, and last month especially, markets get pretty choppy in all asset classes, not just the
Mhm.
risky assets, but even safe assets like treasury bonds. My audience, clients, they hear me beat this to death about being careful about rising rates, and if it ever happens, owning the right assets, owning the assets that you get paid to take risk on. And so, given what's happened recently, for our audience, maybe just share what are your thoughts on why the market is so concerned with the idea of rising interest rates?
Well, I think it's which interest rate is rising, right? Higher 10-year yields is actually probably a pretty healthy sign for equities because, if you think about the 10-year, it's really considered by many in, like the CAPM model as a risk-free rate. So when the 10-year is super bid, meaning yields going really down quickly, like they were that day that a year ago in March when people were panicking, that's usually because the rates market is saying, things are going to get really, really bad. It's the flight to, perception of safety, right? I don't know. I personally don't think treasuries are risk free, but the perception of safety. And so higher long dated yields is actually a more risk seeking environment. Generally, it means that people, are able to feel like they can take risk. Whereas, lower front-dated yields is typically a more, people are concerned about the Fed might have to cut rates or we're going to be in a risk-off environment. So it's a pretty, interesting dynamic because a lot has changed in the level of rates since just a year ago, and obviously a lot has changed in fundamentals as well.
Right. And I think, with some of those areas, there's different viewpoints, right? Just in the last few weeks, whether it's growth stocks, value stocks, treasuries, tips, real estate. I mean, everyone's talking about their own views and opinions, which is interesting. And I think that's maybe why people are trying to figure out kind of where to be positioned going forward.
Mhm.
If you look at those longer rates, you mentioned just the 10-year, to kind of look at some of my notes here. In past discussions, we've talked about this, but if the 10-year or even some of these other rates you've mentioned that exist continue to rise, what are some of the things that investors should really be aware of? What should they be thinking about when it comes to investing and planning for the future?
I mean, I think people have to be scratching their heads at least, in nominal treasuries. We've had a little bit of a move higher in rates and they've lost a lot in price. So, yeah, if you sit and hold them till maturity, you'll get back your principal. But I think it has been a little bit of a wake up call for, especially for 60/40 portfolios, where you've had this stock bond correlation not always holding, So I think generally investors are looking at ways of diversifying themselves and figuring out, is a plain old 60/40 the right mix going forward, or is it important to be thinking about other things?
Right. And we do a lot of planning for clients, not just for retirement, but other goals they have. And a lot of that has assumptions that apply to that, right? Whether it's a 10-year looking forward interest rates, expected return. And you're right. With a 60/40 portfolio or something else, that's a huge, or can have a huge impact.